You know, in the world of crypto, few projects have managed to stir up as much passion and as much pure controversy as the Pi network. It's a real split. On one side, you've got this massive global movement that promises to put cryptocurrency in everybody's pocket. But on the other, you've got critics calling it one of the most clever and potentially deceptive schemes out there. So what is the real story here? Let's dig in and try to separate the facts from the hype. And that question really gets to the heart of it all. We're talking about a user base of over 60 million people. I mean, that's bigger than the population of most countries. So the big question is Pi Network a quiet revolution, building the future of digital money from the ground up, or is it something else, something fueled more by social referrals than any real solid technology?
Okay, so to really get a grip on the controversy, you first have to understand the vision. And Pi's mission, it was incredibly ambitious. And for millions of people, it was incredibly appealing. It was all about one simple idea, making crypto accessible for everyone.
So what is it, really? Well, at its core, Pi is a Layer 1 blockchain. But its big selling point, the thing that got everyone's attention, was mobile mining. The idea was just so simple. Anyone with a smartphone could help secure a crypto network and earn rewards. This completely tore down the huge technical and financial walls that keep most regular people out of crypto. And the process itself was honestly kind of brilliant. It was totally gamified and just dead simple. You download an app, you tap a button once a day, and then you build a little security circle with people you trust. And hey, if you invited more people, your mining rate went up. This tapped into some really powerful psychology. It's a low-effort daily habit, and when your friends are doing it too, it just feels easy and right. And to really hammer home this user-first vision, the project's own documents show this massive commitment to its community. A staggering 80% of all the tokens are set aside for the users through mining and other rewards. The message was clear: this was built for the people. And man, this has been a long time coming. The project kicked off way back in 2019. It spent years in what they called an enclosed mainnet, where your tokens were basically trapped in the ecosystem. All of this finally led up to the big open mainnet launch in February 2025, a moment that was literally years in the making. Okay, so that's the promise. But when we start to look at the reality of the situation, the picture gets, well, a lot more complicated. And for many people, it gets a lot more troubling. And this right here is the central contradiction. The entire premise was decentralization, built on this idea of a trust graph made up of its users. But then you see reports from 2025 saying that all the main net nodes, the actual computers that validate all the transactions, are run centrally by the Pi core team. That is the literal opposite of decentralized. And here's the other thing. While it's super easy to mine Pi, actually getting your coins is a whole different story. To move your coins to the mainnet, you have to go through a mandatory KYC process. That's Know Your Customer. This directly links your crypto wallet to your real-world identity, and all that sensitive data gets stored on centralized servers. In a world built on privacy and anonymity, that is a major, major red flag. And the list of concerns just keeps going. That heavy focus on referrals, it's drawn a lot of comparisons to multi-level marketing, or MLMs. For years, the project didn't even have a detailed white paper. The timelines were vague. They ran ads in the app, which made people wonder if the real product being sold was just user data. And even today, after the mainnet launch, you can't find Pi on any major exchange like Coinbase or Binance.
This quote from Justin Bonds, a pretty well-known founder in the crypto world, really sums up the deep skepticism from a lot of industry insiders. He and plenty of others have pointed to all these red flags as proof that the project's entire structure is fundamentally flawed from the get-go. All right, so now let's look at what actually happened when this project, with all its promises and all its problems, finally went live on the open market. Well, what do you think happened? With years of pent-up demand and hype from literally millions of users, the price exploded. It shot up to nearly $3 right after the mainnet went live. For all those early believers, it was a moment of pure triumph. But that triumph was incredibly short-lived. By October of that same year, the price had completely collapsed. We're talking a crash of over 90%. It wiped out almost all of its initial value, leaving it trading for just 20 cents. So what happened? What on earth could trigger such a catastrophic sell-off after so many years of waiting? The answer really comes down to simple supply and demand. To put it simply, a tsunami of new tokens just flooded the market. See, for years, all those mined coins were locked up,
But starting in mid-2025, huge amounts were unlocked and became sellable, over 300 million in just 1 month. By the end of the year, there was an estimated 1.2 billion tokens floating around. The selling pressure was just overwhelming. But that massive wave of selling pressure was only half the problem. The other half is who holds the supply. A mind-boggling 96% of all the circulating Pi is held by the top 100 wallets. These are most likely early insiders. This creates a huge risk because a decision by just a handful of people could completely tank the market for millions of others. So, with a collapsed price and some really serious criticisms about its structure, you might think the story ends there, right? Game over. But it's not. The core team is still building, and they have an ambitious roadmap that they hope can turn this whole thing around.
On the tech side, the team has laid out some major upgrades they hope will build some real utility. Protocol 23 is supposed to bring in DeFi tools, like a decentralized exchange on their testnet. They're also aiming for ISO 22002 compliance, which is a big deal if they want to align with global banking standards. And an integration with Chainlink will let developers build much more sophisticated apps. And they're putting their money where their mouth is to try and build a real-world economy. They've launched a $100 million venture fund to support businesses building on Pi, and they claim there are already over 125,000 merchants out there accepting the coin for goods and services. And that brings us right back to our original question. Pi Network is really at a crossroads. It has, without a doubt, successfully built a massive global community. They did it with hype and a simple, powerful promise. But now comes the really hard part, delivering real, tangible, decentralized utility. Its entire future and the fate of its millions of users depends completely on whether it can make that leap from a social experiment to a functioning economy. The path it chooses next is going to define everything.